This is part of a bigger portfolio shown here. That period in 2017 to 19, you can see it doesn't affect our equity growth. Hello everyone and welcome back to Statira Trading. Now, yesterday was a very important day for us. We launched our beta launch for our algorithm Sequenti. Just want to say a massive thank you to all those who signed up, and we're happy to have you on this journey with us. Now, today we're going to go through the beta launch, how you can still get involved with it if you're not already involved, and then move on to more about the mindset sort of thing. So the reason we're going to go over that is we think there's so much benefits about going over mindset that will help you on your way to being an algo trader or renting our own Sequenti. It's going to be a great episode and we'll jump right into it. So if you are interested in getting involved within our beta launch, just follow the simple steps shown here. So first of all, go to your search engine. We're using Google and type in Statira Trading with no spaces. We then go to the top website, which is statiratrading.com. That's our website. We then go to our EAs. And then we go to our core EAs, which is Sequenti. So we just click on Sequenti. And from here, there's loads of information on what does Sequenti do, why Sequenti, and our results table at the bottom. So all we do next, if we're interested in buying Sequenti, is press Buy Now. And this will take you to our landing page that gives you, a couple of reasons as to why to buy Sequenti, the 4 steps on how to set it up, and obviously the price. Now, the price was originally going to be $199 per month. But we've decided, since this is a beta, we will give £50 off per month. And it's a reoccurring bill, so roughly 25% per month off. Now, this price will stick if you do purchase it during the beta period. You will stick at the £149 per month. After the beta period, we will be going up. So if you are interested, you simply just press this Buy Now button, and it will take you to the payment processor. And after you've filled in your details and paid for it, you will then receive a welcome email with further instructions on what to do next. So next, I just want to rewind to last week's episode. We went over some interesting points in the do's and don'ts, and I want to dive deeper into the underlying reason to why we use these points. So the first point I want to go over was point 1. Have a long-term mindset and let the probabilities play out. This is fundamentally the most important thing for us as either traders or investors, because there is going to be periods where you go through some drawdowns, some stagnation periods, and these are the time where you've got to really think deep and think, okay, let's look at the results. Let's look at past history if you're an investor. What is the probabilities of this playing out? So depending on what it is, there can be so many different fundamentals or technicals behind it, but we are going to jump in to a thing everybody is familiar with, the S&P 500, and go through these long-term mindsets and probabilities playing out. So let me just jump on the charts now. So I have pulled up the S&P 500 chart on TradingView. Now, if you don't know what the S&P 500 is, it is a stock market index tracking the stock performances of the top 500 companies in the United States. So it creates price and people invest in it over the long term or trade it on a day-by-day basis. But basically every investor knows about this because it is a very well-used long-term growth strategy. When you look at the average returns of the S&P, since inception, it has been about 10%. Now, historically, that's a great return over the length of time it has been on the market. But it does have its flaws, and this is how deep the drawdowns go. and how long they last for. That's my main flaw with this index. For example, let's look at today's market. Currently, the S&P is in a bit of a bear market. The start of 2022, it peaked and dropped 27% over, I believe that is just less than a year. But fast forward to today, we're still down 17% from the peaks, and it's been 420 days now. So it has been in a drawdown for quite some time. But one of the questions that we do, that people ask when starting investing stuff is like, well, how long will it be before it is equal to its high or peaks it? Now, that's a difficult question because nobody knows the answer to this. But if you've got a long-term mindset and this is your asset class that you invest in or index that you invest in, because historically it does well, you don't really care when it does because, over the long term, what to expect. We expect this to, at some point in the future, I don't know when, to far past this peak. And these people that invest in this are quite happy to go through these drawdowns and hold them on, and they can last a long time. For example, I believe a period of time that would test people's psychology and mindset of this long-term mindset is if we go to mid-March 2000. I think it peaked at roughly about $1,552 for one share of the S&P. Now, over the next 931 days, that constantly went down over the long term and peaked at about 50% down. Now, just under 3 years is a long time. Do you think that you could go through that drawdown if you didn't have a long-term mindset? No, you couldn't. And this is something that traders can all learn from as well. And it'll lead into points that I'll make further on later on. But, can you as a trader keep using a strategy for the next less than 3 years and just constantly see losing results? Most traders would bin that strategy and go in that repetitive cycle of moving on to the next thing. But when they do that, sometimes they miss out on all the results. Now, the reason they could be down 50% in a trading strategy is multiple things, but we'll get into that in a little bit. But, my question to you is, during this period, right, how many people do you think would have lost faith in this index and sold out? Quite a lot of people, I believe, would have done that because it took roughly about 2,667 days before that 50% down period was then filled to the peak again. Now, that is a very long time, and I believe that most people couldn't go through that because psychologically, all you would see is your capital going down and never going up. So, looking at this, what can we learn from people that think long term and apply it to the way that us as manual traders, algo traders, or algo leasers can use to build that long-term mindset? So, yes, this has gone through some really deep periods, but if you stick to what you know, and we have statistics here for our own algorithm, Sequenti, that we know what the peak drawdown is over the given time. We know what to expect in terms of return. We just don't know when the sequence will happen. Similar theory to the S&P. People just say, because it's went up 10% a year, they still think it's going to go up 10% a year. So statistically, that's what they're looking at. But let's move on to two of the things I mentioned in last week's video that can help us as traders or investors build that long-term mindset and will make it a little bit easier for us in the long term. So 2 ways that we can make long-term thinking a little bit more easier for us is to, 1, diversify your portfolio, and 2, apply low risk. So now I've jumped on Quant Analyzer and pulled up our own algorithm Sequenti just to give you it as an example of how to diversify and apply low risk. So From this, we can see that this blue line is our portfolio of Sequenti. Now, within this, we trade six different, so three different currencies. We trade a metal, which is gold. We trade an energy, which is UK oil. And we trade an index, which is DAX. Now, all of those are completely different and will be uncorrelated to a certain degree. So we first of all have pound yen, then we have pound dollar, then we have US dollar yen. They are our three main currencies that we trade. Yes, there is some correlation between them, but they're all completely different markets and move slightly different. We then trade gold against the dollar. Now, this is obviously the price of gold against the US dollar, which again will move completely different to how other markets move. So, we're not just diversifying within forex, the currency market, we're also looking at metals. And then we go even further and we looked at UK oil. So basically, we're just trading the price of a barrel of oil. So again, completely different to gold, completely different to currencies. And then we take it one step further and go into the German DAX, which is an index. Now, the German DAX is built up of the top companies within Germany, so it's completely different to everything else. This has allowed us to build diversity within our portfolio. Now, you can do it this way, or you can trade the same sort of currency pair or whatever it is you trade and apply multiple different strategies to this. So with Sequenti, it's simply just a breakout system. So there is no diversification within the entry model, but there's diversification within the pairs that we trade. Now, to show you exactly why we trade different asset classes is let me pull up the pound dollar chart between 15 and 23. So obviously this blue line is now our pound yen chart. And what you can see is it can go through some pretty heavy drawdown periods in terms of like how long it lasts. So for instance, let's look here. I think it is about the start of April, and it just steadily goes down. Reminds you of that S&P graph, steadily going down, steadily going down, If you kept on trading this, so I think it is, let me just have a quick look. It is almost a year and a half before it then breaks. Maybe even, 1.5 years to 2 years before it breaks its peak again. Now, this shows you why we diversify in different asset classes that we trade, because if you were just to trade that for that period of 2 years, most traders would give up. A lot of investors would be like, I'm not too sure. But this is why we diversify. And again, this shows you psychology of what humans are like. So someone might give up around that January the 2019 thinking, okay, that's been nearly 2 years. Nothing's working. But they're not missing out on the long-term approach. So with a long-term mindset, like we've said earlier, let's apply saying, we know the strategy works and it always goes up. We don't know that. Nobody knows that. But let's apply that theory like people apply it to the S&P. If you just zoom out and you know the statistics and it's not out with statistics, why are we quitting? You shouldn't be. But again, this is part of a bigger portfolio shown here. That period in 2017 to 19, you can see it doesn't affect our equity growth within our chart. This is the power of diversifying. Now, let's go again, keeping on Quant Analyzer, let's go to the drawdown periods. So let me just pull up the stagnation marker so it should show us. Okay, so there is our stagnation period for this. And we can see that it lasts for 170 days. So as much as that might sound long compared to the S&P or even compared to our own algorithm statistics on pound yen, it's a very small period. And that is exactly why we use diversification. But going on to the low risk, because we're in that bit of a down period and a bit of a sideways action, we know if we risk low, the drawdown is going to be minimal, which is what we want to do when we're in losing periods. Because, if you keep to let's, for instance, give you an example. If you were sticking to 1% risk per trade, that seems to be the standard within trading and is all very well and good, but can you keep risking 1% when you're going in these heavy drawdowns? If we think about that graph that we pulled up on last week, once you're down 50%, you need to make 100% gains. So keeping things low risk like we do, we risk 0.3% per trade. So we risk a lot less than what is the standard. And that allows us to get, if we go to our statistics to, let me pull up the portfolio, if I can get to it. Portfolio. That's why we can get this portfolio now to a 5.6% drawdown. Because we're diversifying, because we're risking low, we're now enabling ourselves to get a steady return year on year, or even like looking at the bigger horizons every 5 years that the S&P cannot necessarily do, and a lot of things that you do individually can't do. So the key things to take away here are risk low, diversify, and have a long time mindset, because putting those three things together are the best things that you can put together to bring a winning formula to when you're either trading, investing, or if you are leasing out our own algorithm Sequenti. So that was a little bit of a longer episode than usual, but we just want to emphasize how important it is to have a long-term mindset and use the two ingredients of keeping a low-risk plan and diversifying your portfolio in order to make things a little bit easier for you. Now, if you have enjoyed this episode, please give the video a like. And if you want to see more, please subscribe to the channel. And obviously, if you are interested in leasing our own algorithm, we're still in beta launch phase, so get involved in that now. But until then, thanks very much, and we'll see you in the next video.